Last-minute, end-of-year corporate tax strategies. As the calendar year draws to a close, U.S. corporations have a final window of opportunity to implement strategic maneuvers that can significantly lower their federal and state tax liabilities. These last-minute actions often focus on the timing of income and expenses, leveraging the 2025 legislative landscape, including the permanent restoration of 100% bonus depreciation under the One Big Beautiful Bill Act. By proactively reviewing the balance sheet before December 31st, business owners can shift the tax burden away from the current profitable year and preserve vital cash flow for future operations. Strategic year-end tax moves. One of the most effective levers available is the acceleration of deductible expenses and the deferral of taxable income. For businesses on a cash-basis accounting system, this involves paying upcoming bills, such as rent, insurance premiums, or professional fees, before the year ends to capture the deduction now. Conversely, delaying the issuance of invoices until late December ensures that payments are received in January, pushing the taxable revenue into the next fiscal year. Even for accrual basis companies, choosing to finalize contracts for services or supplies by year-end can lock in deductions that would otherwise wait until the following year. Capital investments represent another massive opportunity for immediate tax relief through Section 179 expensing and bonus depreciation. For 2025, the Section 179 limit has been increased to $2.5 million, allowing businesses to fully deduct the cost of qualifying equipment, software, and even certain building improvements like HVAC or roofing in the year they are placed in service. Furthermore, the One Big Beautiful Bill Act has permanently restored 100% bonus depreciation for assets put into service after January 19, 2025. This means that if a company purchases and begins using new or used machinery, vehicles, or office technology before the clock strikes midnight on December 31st, they can often write off the entire purchase price immediately. Beyond equipment, corporations can optimize their tax position by addressing compensation and retirement planning. Paying out declared employee bonuses before year-end is a standard way to reward staff while reducing the company's taxable net income. Simultaneously, establishing or maximizing contributions to employer-sponsored retirement plans, such as a 401k, SEP IRA, or defined benefit plan, provides a double benefit. It serves as a powerful talent retention tool and creates a dollar-for-dollar reduction in corporate profit. Importantly, while some plans can be funded later, many must be legally established by December 31st to count for the current tax year. Finally, businesses should look toward charitable giving and inventory management to capture remaining savings. Making a significant corporate donation to a 501(c)(3) nonprofit by year-end is not only a boost for corporate social responsibility but also a deductible expense. For those with physical goods, performing a year-end inventory review to identify and write down obsolete or damaged stock can result in an immediate deduction for the loss in value. Combined with a thorough review of available tax credits, such as those for research and development or energy-efficient upgrades, these actions ensure that a corporation enters the new year with a minimized tax bill and a maximized bottom line. We welcome you to subscribe to our YouTube channel for more informative videos on taxes and finances. Thank you.